The market just handed us a masterclass in human predictability. While everyone was debating whether this rally has legs, the real story was playing out in the shadows, and most people missed it entirely. I've spent the last 15 years studying how theological anthropology intersects with market behavior, and what I witnessed this past week between Christmas and New Year confirms everything I know about human nature. The crowd thinks they're trading technicals and fundamentals. They're actually trading their own psychological limitations. Here's what the data reveals about human behavior, and why this creates systematic opportunities for those disciplined enough to exploit them. The S&P 500 gained 1.4% last week, hitting new intraday highs at 6,945 before closing Friday essentially flat. Nvidia rallied 3% Tuesday on a licensing deal, then went nowhere. Gold hit its 54th record close of the year, while silver notched its 5th consecutive all-time high. Bitcoin sits trapped near 87,000 after touching 126,000 in October. Most traders see random price movements. I see human psychology expressing itself through predictable patterns. The human layer tells us everything we need to know. This was the week between Christmas and New Year. When institutional desks close, liquidity thins, and markets become playgrounds for positioning rather than conviction. What emerged wasn't panic or euphoria, it was calibration. Traders adjusting exposure at the margins while the broader narrative remained intact. But here's where it gets interesting. The psychological undercurrent was cautious validation. After 3 consecutive years of 18+% gains, participants faced cognitive dissonance, markets climbing while fundamental justifications remained debatable. GDP printed 4.3% versus 3.2% expected. That should have triggered celebration. Instead, consumer confidence dropped to 89.1 from 92.9. Classic late-cycle behavior. Markets front-running recovery while households remain skeptical. The theological perspective explains this perfectly. Human beings are predictably flawed. Fear and greed don't operate on spreadsheet logic. They operate on narrative and emotion. The market was pricing in perfection while consumers were pricing in uncertainty. One of these perspectives will be proven wrong. Violently. Now watch what the system did with these human inputs. Gold and silver hitting all-time highs while equities also rallied, signals bifurcated risk perception. Some capital sought inflation hedges, other capital chased AI momentum. This isn't contradiction, it's diversification of fear. Participants hedging different tail risks simultaneously. The crypto sell-off from 126,000 to 87,000 wasn't isolated. Japanese 10-year bond yields spiking to multi-decade highs, unwound yen carry trades, forcing liquidations across risk assets. Bitcoin, sitting at the apex of the risk curve, absorbed the first wave of deleveraging, $640 million in liquidations. Technical washout complete, but the failure to reclaim 100,000 despite institutional ETF infrastructure suggests demand exhaustion. Sector rotation provided the clearest signal. Materials outperformed as copper broke 12,000 per ton. Information technology, up 25% year-to-date, showed relative weakness. This wasn't defensive rotation, it was commodity reflation. Markets pricing in infrastructure demand and monetary debasement simultaneously. The system's verdict, trend intact, momentum fading, rotation accelerating. Here's where stoic discipline separates exploiters from victims. The dual rally in equities and gold is historically unstable. One asset class is typically wrong. Either equities are overpricing growth, and gold is correctly pricing debasement, or gold is overpricing inflation risk, and equities are correctly pricing AI productivity gains. Both can be temporarily correct. Neither can be permanently correct. The resolution comes through volatility, not consensus. The AI infrastructure narrative remains the market's organizing principle. $380 billion in CAPEX commitments from 4 companies represents the largest private infrastructure build-out in history. This isn't speculation, it's capital deployment at scale. But here's the question that matters. Are current valuations already reflecting that transformation? Nvidia trading at elevated multiples after a 40% year-to-date gain suggests the market has priced in several years of growth. The rotation into materials and financials indicates participants are seeking value outside the consensus trade. The consumer confidence drop while GDP printed strong reveals the gap between aggregate statistics and individual experience. This divergence isn't sustainable. Either confidence rises to meet growth or growth falls to meet confidence. The stoic exploiter prepares for both outcomes without predicting which occurs. Technical structure remains constructive but fragile. The S&P holding above its 50-day moving average with VIX at 14.08 indicates trend continuation, but lack of volume and breadth suggests shallow support. A break below 6,850 triggers technical selling. A break above 7,000 triggers FOMO buying. The range is narrow. The catalyst will come from outside the market. This is where anti-fragile positioning matters. Portfolios that benefit from volatility rather than suffer from it are positioned correctly. Long volatility through options, long real assets through commodities, long quality through free cash flow generators, short duration through floating rate exposure. The market isn't offering asymmetric opportunities at current levels, it's offering symmetry. The disciplined exploiter waits for asymmetry to return, which it will, through volatility. Remember, we don't control outcomes, we control process. We don't predict market direction, we position for multiple scenarios. The crowd reacts emotionally to each data point. We remain systematically disciplined. The week's rotation into commodities and out of mega-cap tech wasn't trend reversal, it was risk redistribution. Capital seeking diversification, not direction. Human nature expressing itself through predictable patterns that create systematic opportunities for those patient enough to exploit them. If you value systematic thinking over emotional noise, hit that subscribe button. The link in the description contains the complete framework for exploiting human predictability in markets. Most traders chase prices. We exploit the psychology that creates them.